Welcome to Deep Economic Thoughts with economist and best-selling author Illán. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Hello, this is Illán, and thanks for joining me today. And we're going to talk about something that I think is pretty obvious. I mean, it at least seems very obvious to me, but there seems to be this big issue around debt of sovereign nations around the world, particularly developed nations, and really fiscal dominance within these developed nations. So we're going to talk about fiscal dominance and the unwinding of the risk-free rate. And I say the unwinding of the risk-free rate because, for so many decades, the U.S. Treasury, 10-year Treasury, has been considered a risk-free rate. Treasury bonds in general have been considered a risk-free rate, which means that all other market rates are based upon the premise that U.S. government debt is essentially risk-free, and other kinds of debt, whether it be corporate debt or any kind, of other instrument that is debt-related, would be built upon this some kind of premium in addition to the risk-free rate that a Treasury bond would pay. And so this is a very big concept, the idea that maybe we're having an unwinding of the risk-free rate. And one of the major theses behind this is that advanced economies are running structural primary budget deficits of somewhere between 5 to 7% of GDP during non-recessionary periods. This is what we've seen around the world in these developed nations. And, we had this promise that after COVID, we'd return to some kind of fiscal discipline. But that has never happened. And instead, we're seeing defense spending and green transition costs. And again, this is around the globe. I'm not singling out any specific advanced nation, but also demographic pressures and industrial subsidies. All of this has essentially institutionalized high government issuance. And so forget about that fiscal discipline. We had a ton of spending that happened because of COVID, and then we were supposed to return to more normal times. But to be very clear, that just simply never happened for some of the points I just mentioned. But what's so bizarre is that equity markets and credit spreads continue to trade at these very low risk premium levels. Option adjusted spreads are very tight still, which is a great metric to look at to gauge the risk premium and credit risk worries in the marketplace. And meanwhile, the long end of the yield curve has been kind of creeping up a little bit. Nothing too dramatic at this point when you look at 10 years around the world. Just even over the past 3 years, India's come down a little bit, and Australia has gone up slightly. The U.S. is up only very slightly in its 10-year over the past 3 years. France is up slightly. Canada's actually down a little bit. Germany's actually up a little bit. Japan has the most dramatic because 3 years ago, its 10-year was around 0.627, and now it's trading closer to 3 at 2.87. And China has actually come down quite markedly. It was about 2.68 3 years ago, and today it's around 1.69 on its 10-year. So all of that is to say is, sovereign debt markets aren't really repricing themselves too significantly, other than what we see in Japan happening. But more importantly, credit spreads are remaining extremely tight. And meanwhile, you see gross OECD sovereign borrowing reaching $18 trillion. And this is with global public debt, and it's expanding rapidly. And inflation, some say it's moderating a little bit, but certainly nowhere near the targets that central banks, certainly in the U.S., would like to see. But sovereign borrowing is just expanding and expanding and expanding. Certainly, we see that quite a bit in the U.S. very rapidly. But the thing that I think is most stunning about this debt expansion is that 80% of the sovereign issuance in developed markets is actually dedicated strictly to debt rollover. And that is, from my perspective, the thing that should catch people, should catch their attention. There should be some concern about that. And the reason for that is because it used to be, we've done some research about this in years past, but it used to be we could see the U.S. government borrow $1, and then in subsequent years we could see GDP expand by $1.3. And instead, now you see the U.S. government borrow $1, and you see very little marginal impact. Maybe the U.S. GDP is expanding by $0.2. So there's this significant diminishing return that has occurred because of this phenomenon. And it's because of the fact that 80% of all this new issuance is going to debt rollover and not actually into any new productive investment for these economies. And so that's very concerning. And it's also interesting to note that there's a big shift in the buyers. And it used to be central bank balance sheets and foreign reserve accumulators were absorbing a lot of the duration that was being issued by governments around the world. And now the debt is increasingly being absorbed by leveraged accounts. I mean, look at the FINRA margin debt in the U.S. at an all-time high. Money market funds are always ready to buy up new issuance. Domestic capital is demanding higher and higher yield compensation. And so these central bankers have, all these ready buyers, and there's all this cash that is in fact sitting out there that wants more yield. And so I think the big issue is that, so much debt is in fact maturing. All this 2020 and 2021 maturity debt is all getting refinanced in the 4 or 5%, type yield range. And so the annual interest service costs is truly an unprecedented percentage of federal revenue, exceeding defense spending, as an example, in the U.S. And so this is the thing to really, I think, watch, which is, what is this interest expense as a percentage of tax receipts? And the trend is that will be increasing. And what is the bid to cover ratio on 10-year and 30-year auctions? These are important hallmarks of demand and appetite, and maybe perhaps some risk perception that starts to creep back into the normal cycle, which we should be seeing. And we published a paper recently on the 60-40 portfolio, and that though it may not be dead, it probably needs some reincarnating, and all of that means to say is that you have to take a more active approach to your fixed income allocations. If you're in these balanced portfolios, and you've allocated 40% of your money into bonds, well, what kind of bonds do you really own? What is the maturity schedule on these bonds? Or another more sophisticated way that people look at it is, what's the duration of your bond portfolio? What is the credit risk of your bond portfolio? And these things matter hugely in terms of their ultimate performance, and also how they move price-wise. Longer-term bonds, when there is interest rate shifts, especially interest rates going up, like they did when the Fed funds rate was near zero and then went up to over 5%. I mean, long bonds were hit 40% in the U.S. I mean, there's a 20-year bonds, they were hit very, very brutally. And of course, stocks in 2022 were also hit very brutally. So bonds did not behave in the way that you typically want them to behave, which is as a hedge against equity market volatility. So there are a lot of implications here for investors, and of all kinds, whether they're ultra high net worth investors or endowments or institutions or fund managers, or the normal retail household, and how they're investing and saving in their 401ks, or they are in retirement, and they're thinking that they may have a nice, balanced, protected portfolio because they own a certain amount in equities and they have a certain amount in bonds. But there's something looming here in the bond markets that are structurally challenged. And this is certainly where we're spending a lot of our attention in viewing, what is the risk as we move forward in time. And with this persistent supply pressure of treasury auctions and all this spending that's happening globally, and all this political fragmentation. I mean, look in Europe, they can't figure out anything. A revolving door of prime ministers in the UK, deficit consolidation and political cohesion across the EU and France is very, very difficult. And, Japan is navigating basically probably one of the largest unwindings of that we've seen in modern history of the yen carry trade, where, now you can actually get a very decent yield on Japanese debt. And it is a huge, massive, outstanding amount of debt that they have. And so this interest expense is going to be very interesting as they navigate forward. And we've seen some of these interesting, kind of the U.S. Working with the Bank of Japan to kind of support the yen because they hold a ton of treasuries, and Bank of Japan could just say, you know what, we're just going to dump all these treasuries. And so there is this inextricably linked issue between these central banks and these economies that you can't ignore. So these are my thoughts, my deep economic thoughts for today, 14th of August here, Friday in Hong Kong, and very rainy monsoon season, typhoon season here. Of course, if you have any questions, always feel free to reach out via email, visiting our website. And thanks for joining me today. Hopefully you got a couple of interesting ideas or insights. Take care.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanillán.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.